Hi everyone, welcome to this session of the Tiger Academy, US Stock Financial Statements for Beginners. In the previous lesson, we reviewed everything that you've learned so far, and I give you 4 phrases to memorize. Do you remember them? In today's class, I'll teach you another very cool method to analyze financial reports, DuPont analysis. DuPont analysis is used to comprehensively analyze the competitiveness of a company and to discover areas of operation that can be improved. At the core of this method is ROE. Although ROE is a broad ratio, it is not a good way to judge a company on its own. To address that, the clever DuPont analysis breaks down ROE into multiple ratios, each addressing a unique operational issue. It takes its name from the American blue-chip company, DuPont, which first used it. To help you better understand DuPont analysis, let's start with 2 examples. Jack and Rose have each opened a pancake shop at the same time, and they've both invested $1 million as startup capital. After taking out different costs, expenses, and taxes, Jack's shop has a net profit of $250,000 at the end of the first year. This means that the ROE is 25%. Rose's shop, on the other hand, has a ROE of 50%. Jack doesn't understand why Rose's business is doing so much better than his, since they both sell pancakes and started out with the same amount of money. To help Jack find the reason, let's use DuPont analysis. First, I teach Jack the formula for ROE. ROE equals net income divided by shareholders' equity. As Jack and Rose have the same amount of startup capital, for example, shareholders' equity, this formula can't be used to find a specific reason. So that we can find the reason with more accuracy, let's break down the formula. I'm breaking down the ROE formula into net profit margin, asset turnover, and equity multiplier. To make it more understandable, I'll further break down equity multiplier like this. By breaking down the basic ROE formula, we can see that the current formula is made up of net profit margin, asset turnover, and asset liability ratio, which reflected profitability, operational capability, and solvency, respectively. Pretty amazing, isn't it? A ratio that, on its own, reveals very little can be transformed into the product of many ratios, which reveal lots of hidden information. This is why DuPont analysis is so useful. Having learned this method, Jack gets the financial data on Rose's shop and uses it to begin a DuPont analysis. First, he writes down the ROE of his own shop. 25% equals 20% multiplied by 6.25 multiplied by 20%. Then he writes down the ROE of Rose's shop. 50% equals 40% multiplied by 2.5 multiplied by 50%. Finally, using this method of breaking down the ratio, Jack finds the problem. Jack's shop has a lower net profit margin compared with Rose's shop. It turns out that, although the pancakes are similarly priced at both shops, Rose enjoys a much lower cost because her boyfriend is a flour supplier, and he gives her a much lower price compared to what Jack pays, resulting in a much higher net profit for Rose. Jack's shop, however, still has the advantage of an asset turnover that is twice that of Rose's shop. Apparently, his industry knowledge and his mastery of finance get good results for him too. Additionally, Rose's shop has a much higher equity multiplier than Jack's because, besides putting in her own money, she borrowed a lot from friends when she opened her shop. This gave her much more operating capital. Jack, however, knows that he'll have to eventually pay back whatever he borrows and so gives up on the idea of getting money from friends. He is not ready to take on the higher risk that comes with a greater financial leverage. Following his analysis, Jack comes up with the following ideas to make his shop more profitable. 1. Reducing purchasing costs will increase his net profit per pancake. 2. He'll continue to maintain the advantage he has over Rose in asset turnover, and he'll try to raise his target for asset turnover. 3. As he has a weak heart, Jack decides that he is not going to take on the risk of financial leverage and play the capital game. Instead, he'll focuses on running his shop honestly. According to this plan, if Jack continues to increase the net profit of his shop, In combination with its high asset turnover, his shop will very likely overtake Rose's without having to assume too much financial risk. Now, are you all clear about DuPont analysis? Simply put, DuPont analysis breaks down ROE into multiple constituent ratios to figure out why a company is doing well or poorly and to find ways to help it to improve its performance. In other words, DuPont analysis helps a company become more profitable, grow faster, and be stronger. In concrete terms, 1. Higher profitability. 2. Faster turnover. 3. Higher financial leverage. One thing to bear in mind is that you don't have to increase all three ratios at the same time. For example, Jack didn't increase his financial leverage because he didn't want to take on more risk than he already had. Therefore, our advice is that Jack concentrates on increasing the profitability and asset turnover of his shop in order to improve its operation. That's all for the DuPont analysis. To sum up, DuPont analysis breaks ROE down into net profit margin, asset turnover, and equity multiplier, which in turn represent profitability, operational ability, and solvency. By looking at each ratio separately, you'll be able to find ways to improve operations from many different aspects. So, do you get this cool DuPont analysis? We'll start talking about the main industry sectors of US stocks in our next class. So far in our course, we've talked a lot about how the importance of particular financial data varies from one industry to another. And I know that many of you want to know more about that. See you next time!